Hey everyone! Today we're going to dive into another essential part of retirement planning, the IRA, or Individual Retirement Account. Understanding how IRAs work can help you make smart decisions about your financial future. Stick around as we explore what an IRA is, the different types available, and how they can benefit you. Let's start with the basics. What is an IRA? An IRA, or Individual Retirement Account, is a tax-advantaged account designed to help you save and invest for retirement. Unlike a 401k, which is offered through your employer, an IRA is something you open on your own with a financial institution, like a bank. The main goal of an IRA is to grow your money for your retirement years, with tax benefits along the way. There are a few different types of IRAs, but the two most common are the traditional IRA and the Roth IRA. Let's break them down. First, with a traditional IRA, your contributions are tax-deductible in the year you make them. So if you contribute to a traditional IRA, you can lower your taxable income for that year. The money grows tax-deferred, meaning you don't pay taxes on the growth until you withdraw it in retirement. However, once you do withdraw, you'll pay taxes on both your contributions and earnings. Then we have the Roth IRA. The main difference is that contributions to a Roth IRA are made with after-tax dollars, meaning you don't get a tax break up front. But here's the advantage. With a Roth IRA, your money grows tax-free, and you won't pay any taxes when you withdraw it in retirement, as long as you follow the rules. Now that we've covered the basics, you might be wondering, should I choose a Roth or traditional IRA? The answer really depends on your current financial situation and future tax expectations. If you think your tax rate will be lower in retirement, a traditional IRA might make sense. But if you expect to be in a higher tax bracket later, a Roth IRA could be the better choice because of those tax-free withdrawals down the road. Now let's talk about how much you can contribute to an IRA. For both traditional and Roth IRAs, the annual contribution limits are set by the IRS and typically increase based on inflation adjustments. In 2024, the contribution limit is $7,000 if you're under 50 years old, and $8,000 if you're 50 or older, thanks to what's called a catch-up contribution, which encourages retirement savings among older people. Every year, the IRS sets new contribution limits, which reset on January 1st. So what happens if you don't contribute to your IRA during a taxable year? Well, unfortunately, the contribution limit for that year doesn't roll over. If you don't use it, you lose it. It's worth mentioning that contributions made for a specific tax year can be made up until the tax filing deadline, usually April 15th of the following year. This means if you haven't contributed the maximum amount to your IRA by December 31st, you still have time to make contributions for that tax year up until the tax filing deadline the following spring. Beyond that deadline, if you don't use your contribution limit, it's lost, and you cannot carry it forward to future years. However, your existing IRA account will stay intact. Your previous contributions and any investment gains will continue to grow until you're ready to withdraw them. But it's important to remember that skipping contributions could mean missing out on years of potential tax-deferred growth. One question that comes up often is, can I have both a traditional IRA and a Roth IRA? And the answer is yes. You can absolutely have both types of IRAs. However, there are a few things you need to keep in mind. First, while you're allowed to contribute to both, the IRS limits how much you can contribute in total across all your IRAs. For example, as mentioned already, for 2024, that combined limit is $7,000 if you're under 50 or $8,000 if you're 50 or older. So for example, you could put $3,000 into a traditional IRA and $4,000 into a Roth IRA as long as your total contributions don't exceed the annual limit. It's a great strategy if you want the immediate tax benefits of a traditional IRA while also having the long-term advantage of tax-free withdrawals from a Roth IRA in retirement. The good news is that almost everyone with earned income can contribute to a traditional IRA regardless of how much they make. However, whether or not your contributions are tax-deductible depends on a few factors. For instance, if you're not covered by a retirement plan at work, your traditional IRA contributions are fully deductible no matter how much you earn. But if you or your spouse have access to a workplace retirement plan, like a 401k account, Your income determines whether you can deduct your contributions. Let's take a closer look at how your income affects your traditional IRA tax deduction. This chart illustrates the relationship between your modified adjusted gross income, MAGI for short, and the amount of your traditional IRA contribution you can deduct from your taxes in 2024. As you can see, if your MAGI is below $77,000, you're eligible to deduct the full amount of your traditional IRA contributions. But once your MAGI climbs above $77,000, the tax benefits start to phase out. The higher your MAGI, the smaller the deduction becomes. And once your MAGI reaches $87,000 or higher, unfortunately, you can no longer deduct any of your traditional IRA contributions. Keep in mind that this example is for the year 2024 if you are single. These income limits are set by the IRS and tend to change slightly each year to account for inflation. Different years may have different income limits, so be sure to look up the specific limits for your tax year. Unlike a traditional IRA, not everyone can contribute to a Roth IRA. It depends on how much money you make. For 2024, if you're single and earn less than $146,000, you can contribute the full amount to a Roth IRA. But if you make between $146,000 and $161,000, the amount you can contribute starts to phase out. Once your income reaches $161,000 or more, you can no longer contribute directly to a Roth IRA. So what if you're earning too much to contribute directly to a Roth IRA, but you're still leaning toward it over a traditional IRA? Well, there's a solution. The backdoor Roth IRA. Here's how it works. You make a non-deductible contribution to a traditional IRA and then roll that amount over to a Roth IRA. It's totally legal and an option many high earners use to enjoy the tax-free growth and retirement withdrawals a Roth offers. But before diving in, remember this conversion might have tax implications. If your traditional IRA hasn't grown, you're in the clear. No extra taxes on the contribution. However, if you have any earnings or pre-tax contributions in there, you'll owe income tax on those amounts during the conversion. It's always a good idea to consult a tax advisor to fully understand how this could impact your tax situation before going the backdoor route. Of course, there are rules about when and how you can withdraw money from your IRA. For traditional IRAs, you'll have to pay income taxes when you start taking withdrawals, typically at age 59.5. And if you withdraw early, you could face a 10% penalty on top of the taxes. With Roth IRAs, it's a bit different. You can withdraw your contributions at any time, tax and penalty free. But to take out your earnings tax-free, you need to meet certain conditions, like being at least 59.5 and having had the account for at least 5 years. While IRAs are designed for retirement, there are specific situations where you can access funds before age 59.5 without the usual 10% early withdrawal penalty. Here's a look at key scenarios. Medical expenses. If you have unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, you can withdraw funds from your IRA penalty-free to cover those costs. Disability. If you become permanently disabled, the IRS allows penalty-free access to your IRA funds to help manage financial needs arising from your condition. First-time home purchase. IRAs have a unique provision allowing first-time homebuyers to withdraw up to $10,000 penalty-free to put toward a down payment. This benefit can also apply to certain family members purchasing their first home. Qualified education expenses. You can also tap into your IRA for qualified education expenses such as tuition and fees for yourself, your spouse, children, or grandchildren without incurring a penalty. Health insurance for the unemployed. If you're unemployed and meet specific requirements, you can withdraw penalty-free from your IRA to pay for health insurance premiums. Substantially equal periodic payments. This method allows you to withdraw funds in equal installments over time without incurring penalties, even if you're under 59.5. However, it requires careful planning and must follow strict IRS rules. Any changes to the payment schedule can trigger penalties, so it's important to fully understand the process. This scenario deserves a dedicated video for further exploration. One important rule to keep in mind with traditional IRAs is that once you hit age 73, you'll be required to start taking required minimum distributions from your traditional IRA. The IRS mandates this so you can't leave your retirement savings untaxed forever. This means you'll be required to withdraw a certain amount from your account each year and pay taxes on it. Roth IRAs, on the other hand, don't have RMDs during your lifetime, making them a great option for estate planning as well. Another important thing to know is that if you have a 401k from a previous job, you can roll it over into an IRA. This allows you to consolidate your retirement accounts and gives you more control over how your money is invested. The best part is, if done correctly, there are no taxes or penalties on the rollover. Here's a quick comparison of traditional and Roth IRAs we've covered so far. Feel free to pause the video here to review the table and make sure everything's clear. So, why should you consider opening an IRA? Let's go over some of the key benefits. First, tax advantages. Whether it's a traditional IRA where you get a tax deduction up front, or a Roth IRA where your withdrawals are tax-free, the tax benefits can really add up over time. Second, investment flexibility. Unlike a 401k, where your investment options are often chosen by your employer, IRAs offer a wider range of investment choices. You can invest in stocks, bonds, mutual funds, and more. Finally, you have more control over your account. Since IRAs are not tied to an employer, you can keep your account even if you change jobs, giving you more freedom in managing your retirement savings. Opening an IRA is straightforward. You can start by choosing a bank, credit union, or brokerage firm that offers IRAs. Once opened, you'll choose your investments, whether that's stocks, bonds, or mutual funds, and you can start contributing. It's a good idea to review your IRA annually to ensure your investments align with your retirement goals and risk tolerance. So, that's the overview of IRAs, a powerful tool to help you reach your retirement goals. Be sure to explore your options and make contributions that work for you. Thanks for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more personal finance tips.